Before we begin this podcast, we would like to remind listeners that NetWealth is licensed to provide general financial product advice only, and that this podcast isn't tailored to any particular person's objectives, financial situation, or needs. Before a listener acts on any advice in this podcast, they need to think about whether it's appropriate for their circumstances or their clients, and consider the product disclosure statement for any proposed investment, and also seek any professional advice they need. NetWealth Investments Limited is the issuer of NetWealth financial products. For NetWealth Financial Services Guide, contact details, and other information about our products and services, you can visit our website at netwealth.com.au. Today's guest is a financial product issuer. NetWealth and the guest have a commercial arrangement that enables investment in products managed by the guest through NetWealth's platform. Under that arrangement, NetWealth may receive fees from the guest. More information about the fees NetWealth receives is provided in our financial services guide.
Welcome to the NetWealth Portfolio Construction Podcast, brought to you by the NetWealth Investment Research Team. In this podcast series, we pick the brains of key wealth management professionals to uncover opportunities and challenges for investors on a diverse range of topics. We hope you enjoy their unique perspectives. This episode, we have Kim Catechis from Legg joining our investment research team to discuss emerging markets and why they should be on every investor's radar. We'll also probe Kim on some of the markets that excite him and why he's so interested in Peruvian banking.
My name's Paul O'Connor and I'm Head of Investment Management and Research for NetWealth Investments. This morning we have Kim Catechis from Legg Emerging Market Capability. Kim is the head of the capability, and we're just going to go through, I guess, a high-level discussion about emerging markets, what they are, why is it an investment opportunity, and understand a little bit more about Kim. So, good morning, Kim.
Morning. Good to be here.
So what exactly are emerging markets, and why are they an important investment opportunity in your mind?
Okay, I think there's an awful lot of definitions out there from different people like The Economist magazine or the IMF. The bottom line is these are countries that are developing economically. Now, you might say every economy is developing, either for the better or for the worse, but these are economies that, generally speaking, are catching up, in a sense, with the big Western economies, of which Australia is one. The reason you would want to be involved as an investor is very simple. The countries that these stock markets are in are growing at a much faster pace. And whilst growth on its own is not really enough to, translate straight, you can't say it translates directly to equity returns. What you can say is that growth, background GDP growth, is always supportive for a company, almost regardless of sector and country in the world. So the way I think about it is these are countries that are undergoing, in a very condensed, say, 30, 40, 50-year period, they're undergoing industrial revolutions, urban revolutions, in other words, urbanization as people leave the countryside to come to the cities. They're undergoing social revolutions and economic revolutions, and in many cases, even ideological ones. And what that means for an investor is that it looks messy and volatile, but actually you're getting opportunities to make money if you go in with savvy investors. You have to be patient, you have to be clear-eyed, but excellent opportunities.
And in terms of capturing those opportunities, I have heard, I guess, some people say that you're better off investing through the developed world and the US companies and the big European companies that are actually selling, predominantly into the emerging world, into China and into India. Do you have a view on whether it's better to actually invest in the country of domicile of the emerging country or to go with the larger developed world companies?
I'm going to say there's two things I think about in that context. One of them is, and this is a fact, it's an observation that I'm making on I think, fact, is if you had the opportunity to meet the top management of, say, Unilever, Colgate-Palmolive, Nestle, and you had the opportunity to meet the top management of Alibaba, Tencent, or Banco Itaú in Brazil, for example, you would be struck by the very different levels of energy that they would give you in a meeting, and the very different levels of knowledge, first-hand knowledge, of dealing with anything from hyperinflation to stagflation and everything in between. So if you've been running a big multinational company, generally speaking, you've not been challenged, really, economic conditions-wise for the last 50, 60, 70 years. If you've been running an emerging markets company for the last 10 years, you've had to deal with an awful lot of this kind of volatility, and that probably makes you a smarter manager in terms of streetwise, being able to deal with adverse environments. The second thing I'd say is, I'll give you a concrete example here. Unilever India is a good example. It's a great company, great history of good returns, great operating structure, etc. One of the key unique selling points they have, or rather what these days people like to call economic moats, is the fact that they are one of the few companies that over the last 50 years has developed a strong distribution network across India. India is a very big country, very diverse from one region to another. That's really important, and that is behind their ability to grow as they have done over the last few years. Now, if you're a stock investor, an equity investor, and you want to buy Unilever India, you'd be asked to pay 56 times PE for it right now. You put yourself in the shoes of Alibaba, for example, or Amazon. Those are both coming into India now. Flipkart is the equivalent company in India. Their model depends on their ability to deliver anywhere across the country. So I think the picture I'm painting here is that Unilever's economic moat is eroding very fast. They're no longer the only company that can deliver. So that means for the first time, users or clients in different parts of the country actually have a choice of what good to buy, what merchandise to buy. So that's one of the good reasons why not to get wrapped up with the kind of superficially safer option of being in a US multinational or a Western company. And the other hard numbers answer is, last but not least, if you're buying Unilever or Nestle, you're buying a percentage of emerging markets shares, emerging market growth. If you're buying the emerging market company, you're getting everything.
Yeah, so I guess my takeout from that is that local knowledge, that local focus is a more pure play and
Correct.
Pure opportunity at capturing that economic growth in the emerging market countries, and then the growth of the companies and the earnings of the companies in those countries.
I'd agree with that.
So why did you enter the fund management industry, and what got you into emerging markets? And I guess, as an investment consultant, I sit back and I see fixed income managers and credit managers and property and global equities and emerging markets. I mean, there's many different areas you could have chosen there.
That's right.
Why emerging markets?
Well, this is the honest answer. It was an accident. I'm not one of these guys who grew up, trading shares portfolios, when I was 5. I didn't even know what a stock market was, to be honest. My first degree was French and German literature, so it gives you an idea of just how far removed I was from this world. My first job after university was working in a plastic packaging company. I wasn't packaging the plastic or doing anything like that, but I was selling these tamper-evident caps, for pharmaceuticals and other goods. And my girlfriend at the time got a job as a trainee investment manager. And after 6 months, I observed that her standard of living and her lifestyle was a lot better than mine. And I thought, what, if she can do it, why can't I? So I just went off and applied to a few firms, got a job offer, and here I am.
Excellent. And is she still in the investment management industry?
She's long gone.
Long gone.
Long gone from my life and from the investment industry.
What are some of the key themes in emerging markets that you see as important?
Okay, I think these, as I said at the opening, these markets are undergoing radical change and multi-level change in a very condensed period. So what that means is that it's going to be, there's plenty of headlines to be written about it, which is, I suppose, good for the financial press. What I think is important is the single biggest driver, I'd say, that people are not focusing on generally, but should be, is a combination of demographics, education, technology, and urbanization. Now, it sounds like a big mouthful. Here's how it all makes sense to me. You got young demographics, generally speaking, in these countries. And young demographics on its own is not enough to say that that's a great reason for investing there. But stick with me for a minute. You got young demographics, that means a lot of young people. Urbanization, because they're coming to the cities to get educated. They come out with a qualification. They end up with a better job than their parents. They get better paid than their parents. Technology, because they all have a smartphone. Smartphones are very affordable. It's one of the successes of globalization. That means they're better informed. Because they've got the smartphone, because they're better informed, and because they're better educated, and here's an example, you know that China churns out 4.7 million STEM graduates every year. That's science, technology, engineering, and maths, and India is another 1.5 million, you know, and the US, by comparison, struggles to get to 500,000, you know. What that means is you're getting a higher education in this young demographic. Couple that with the fact that they've got the power of the internet at their fingertips. These are young people who do not use checks, for example. You've all heard of PayPal. You know, I'm a user. PayPal has got about 200 million users worldwide. Alipay, which is Alibaba's equivalent activities, go over 500 million. Paytm, which is the Indian equivalent, has got 230 million. You know, so these are young people who've basically skipped a whole generation's worth of technology. They probably never owned a PC, you know, went straight to the mobile. And that is powerful because on its own, that helps spread better information. These people use this for their payments. And last but not least, and this is where it gets really powerful for me, and that is that these young people are joining the middle income group. So in a country like Brazil, for example, about 150 million people, 10 million people have joined middle income in the last 8 years. Now that's a very powerful dynamic for the country because all of a sudden these people are starting to become consumers. One of the things that classically happens to you as you join the middle income group, or in our experience in the West, maybe you get a job and you've been working for a while, you suddenly realize that tax is a big part of your life. You know, you think you've worked pretty hard this week and how much of that has actually gone into your pocket. So these people naturally say, hang on a minute, I'm paying tax in a meaningful way now. What am I getting for this tax? So unlike their parents who have tended to kind of not question the big traditional parties, these young people are demanding. They want to know, how much did you spend on that soccer World Cup? And my buses don't run on time. And by the way, the trains are rubbish. You know, how does that work out? So what we're finding is that, A, in common with lots of other countries around the world, the standing and the respect of and the trust of the old traditional political parties is gone. You've got a plethora of new, some of them opportunistic, you know, pretty poor quality nationalists or demagogues, but also very strong regional parties and independents. That all this, you can see where this is going. It means that whereas in the past it would have been common to have been voted a member of parliament in a given country and expect to be there for 30, 40 years. Nowadays, the average tenure of an MP it's not quite as short as an Australian Prime Minister, but it's getting that way.
Yes,
so what I'm trying to say is it's really powerful because what this is a force for the good. It's a force for pushing and enforcing better quality governance. And governance is the single guarantee for any of us, you know, of improved lifestyle. In the end of the day, democracy isn't really just about the airy-fairy stuff. Democracy is about having institutions that are strong and work hard and work well and protect the individual.
Yeah, and I guess it's about driving an improved standard of living at the end of the day.
Right.
But it's very interesting, the comment you make there, Kim, around the social contract with taxation and the fact that the more an economy develops, the more people pay in tax, the more they actually expect a return from the government in the aspect of better roads, better schooling, better hospitals, the key things that societies need. So it's interesting that, you know, in your emerging market portfolio, that is where that money is being invested in, improving the standards of living. What do you see as the major risks that investors should be aware of in the emerging world?
Okay, I'm going to start with a risk that's counterintuitive, and that is I think it's a significant barrier to you as an investor making the returns you could do in emerging markets to think emerging markets are risky. And I know it's counterintuitive because, of course, there's risk, right? But I'm trying to say don't start from the perspective that somehow emerging markets are more risky than developed. Let's take why I'm saying that. We talk about politics, right? Politics is really important for investors. Investors should never take politics for granted because what's going on in the country's politics has a direct impact on policy direction. Policy direction, in turn, has a massive direct impact on the cash flows of the companies that you might be investing in. So the dominoes are pretty clear to see, and one will tip one way, it'll knock these dominoes over, and if it tips the other way, it'll knock the other ones. It is traditional to think that politics is less transparent and more volatile in emerging markets. Let's look at Western politics over the last 10 years. Brexit in my country, Trump in the White House, Germany's AfD growing stronger, Swedish elections recently. These are countries that you would normally have been brought up to think are very stable politics, not much to choose between the main options. And as a citizen, as an investor, you should think these are no-risk countries. There's a big risk in investing in the US right now, and I'm not even talking about valuations. Think about it this way. Say you're investing in General Motors, right? General Motors, big company, automotive, etc., worldwide presence. Trump gets in, and he says, we're going to start a tariff war with China, and I'm going to raise tariffs on steel. So you think, okay, that's fine because I'm an investor in GM. GM buys 80% of its steel from U.S. suppliers. They're a good corporate citizen that way. The overall economy of the U.S. requires a third more steel than the U.S. suppliers can produce. So that's where the imports were coming in from. Tariffs go up on steel. What do the American producers do? They raise their prices to match the tariffs. So at the last earnings quarterly announcement, the management of GM put out a warning downwards, guided down on their earnings for the next 2 years, 2018 and 2019, because in spite of them being good corporate citizens and buying 80% of local steel, they're having to pay the high price anyway as if they were just importing it. So I think that's an example of, perceptions of risk. Let me give you another example, and this is a really good one. I was the oil and gas analyst for the team for 9 years, and I once went to hear Rex Tillerson speak, and this is in the days when he was head of Exxon, one of the biggest oil companies in the world. And somebody asked him a question, said, you're obviously operating in lots of different countries, varying degrees of political stability. Where would you say you have the biggest risk in Exxon? And he said, without a doubt, the United Kingdom. Now, everybody was kind of shocked, jaws were dropped and all the rest of it, but what he was meaning was that Exxon at that time had acreage in the North Sea, and in the preceding 9 years, there were 19 changes to the taxation of those North Sea revenues. So I'm just giving you an indication here. From a perception of reading the newspaper, you might think emerging markets are tremendously risky. They are risky, just like everywhere else, is the point I'm trying to make. The second biggest risk, I'd say, is to assume that all these countries are going to end up looking like yours. They're not. China is not going to be like Australia. China is not going to be like the UK or the US. They have set their stall out. They believe that their model is the one that is correct for them, and they're going to continue in that direction. The next thing to think about is don't assume that because a reform that is being tabled makes sense to you as an investor. In other words, cutting social welfare, pension reform, these kinds of things. Don't assume that means that it's a no-brainer they're going to go through. They're not, because there's real people who are going to be impacted by these things and real politicians who depend on those votes. So it's highly unlikely. I'm always very skeptical in terms of expecting reforms to come through as expected, because at the end of the day, no politician around the world, it's like we say in Scotland, I don't know if you say that here, it's like turkeys voting for Christmas. They're not going to vote for something that is going to end their political career, because most of these reforms, there's a price to pay up front before you see the benefits several years down the line. So the only thing that the citizen sees is you're trying to cut my pension, or you're trying to raise my retirement age.
Interesting there, Kim. I guess I've heard a fair bit over the years on the fact of around corporate governance. And years ago, as a young guy, you would hear portfolio managers saying to me that corporate governance in the emerging world is lower, and so hence you have a bigger risk. The management of the companies simply don't quite have that same level of, developed regulations and understanding of running the business. How do you deal with that type of risk? And is that risk sort of dissipating compared to what it was 10 years ago, appreciating that the emerging world is a very diverse makeup of countries?
Yeah, look, I mean, I'd say that short answer would be definitely improving. And in the 22 years that I've been in covering emerging markets, there is an indescribable level of improvement. What we've also got to bear in mind is that a lot of these companies, it's not so much that they're, that poor behavior is driven by unethical sentiment or greed or anything like that. You have the same instances as you do on Wall Street, as you do in the City of London or anywhere. There are a number of corporate scandals that have just come out this year, in the UK, for example, British Home Stores and Sir Philip Green, milking the pension fund and then selling the company, for example. I mean, that's pretty unethical behavior. The guy's still a lord. He hasn't, paid the price for it. And if he were Indian, I think, we would be making a much bigger song and dance over it in the UK.
Yes. Or Chinese, he'd be
or Chinese.
And you wouldn't hear about it.
Well, in China, yeah, that's a very good point, actually, because China probably has the strictest impact on this kind of behavior.
Yeah.
So if there's poor behavior, there's a price to be paid, and it will be paid. In the UK, it's not always been the case. But coming to the point of your question, what I'd say is clearly there's variability, but without a doubt, changes have been coming through, thick and fast. I'd say, broadly speaking, corporate governance today is so much better than it was. And to give an indication, we are big believers in taking governance and ESG generally very seriously as part of our analysis, because if for no other reason, that's a really good guide to getting to good quality managements, right? But I'll give you an indication. We engage with companies all the time on where we think they're weak and missing, the big gap between where they are and best practice. And the kinds of things we're engaging on government most frequently are relatively what I would call technicalities. So what that means is a lot of times we're complaining because they're putting through bundled resolutions. Vote for all my board members in one resolution. And we're trying to say, no, you've got to give us the option to vote each one individually, because then we might not like to renew this one. We think he's maybe on too many boards, and those kind of thing. Other things that we tend to complain about is approvals to issue shares for bonus schemes without giving enough detail as to how the metrics work. So we don't have a thing against compensation. We think people should be compensated, but we just need to know what the rules are and keep them transparent and make sure that they're respected. And so there's really kind of technicalities, I would say. Now, clearly, because we're stock pickers and because we only hold 50 stocks, we don't tend to have problems on corporate governance. But clearly, there are some bad behaviors out there, and we will be aware of them. And clearly, it's a buyer beware kind of situation.
Yeah, well, I guess at the end of the day, I think it's a key point where to play in the emerging world, to invest a portion of your portfolio into these equities, you need to have people managing it, looking at these risks and understanding what they are. I think is a key tenet as well there, Kim. What are some of the major themes in your portfolio then? So if I invest in your portfolio, you mentioned about, I guess, the rising consumer, the use of smartphones, the way certain countries are leapfrogging certain levels of technology. What am I going to get exposure to in your portfolio if I'm an investor?
We work hard to have a wide distribution of themes, because you don't want the whole thing hanging on one. So there's a number of things in there. First of all, I'd say, demographic and consumer and urbanization, that side of it. We own, we'll get you an exposure to affordable housing in Brazil, for example. We'll get you exposure to relatively big companies like Tencent and Alibaba, because we believe there's an awful lot of ground still ahead for them. I'll give you an example. Tencent has built an ecosystem for its customers whereby, unlike Facebook, they only see one advert a day, and so that's an example. If they go to 2 adverts a day, then that doubles the advertising income, right? Secondly, they have built a system whereby you join an equivalent to WhatsApp It's called WeChat. And then that you can be on that, chatting to your mates. You can be playing a game, an online game, which Chinese love. And you can be you'll be remembering all of a sudden it's your wife's birthday, so you can order some flowers and have them sent off. Think about your holidays and, check some flight prices, all of that without leaving that platform. So that's one way that these people are very sticky. So using only one advert a day is clearly deliberately not trying to monetize yet. So that shows you an indication of just how much growth there is ahead. Other themes that are maybe less sexy is utilities. So one of the companies we own is China Gas. It does exactly what it says on the label. They basically take gas from the city gates and connect households and businesses. And in many places in China, there are still lots and lots of people who use coal for cooking. The government has made a directive that they don't want that to be the case for obvious reasons. They have decided they want to double the use of gas as a source of natural gas as a source of primary energy. And these people, amongst other companies, are beneficiaries of that. They're very good executors. They've been awarded other franchises on the strength of their execution to date. Last year, for example, they plugged in 4 million homes. So there's still a lot of road ahead there, and that's quite a different theme from the others. One last one I'd give you is plain vanilla banking. Banking's got a bad name, deservedly, in the West because of 2008 and the move to transactional banking rather than relationship banking, whereas they say in Scotland, I kent your feather, which means I knew your dad. That kind of bank manager.
We've got a small Royal Commission going on into,
that's right,
our banking sector at the moment.
This is one of the reasons I'm bringing it up, because I think it's topical. So put yourself in the situation of Credit Corp in Peru. Credit Corp is the biggest financial enterprise there, commercial bank, retail bank. And Peru has a population of about 32 million people, average age 27. About 15 million are formally employed. In other words, they're paying their taxes, they're paying their national insurance, etc. So you've got good history on them. Less than 200,000 mortgages in the system.
Oh, wow.
So that just gives you an idea. Now, this is an overcapitalized bank. They've been very cautious.
The growth opportunity.
The growth opportunity there is plain vanilla banking. It's not, something complex that nobody understands and, you're just trying to flog things to grannies that they shouldn't be buying. This is good, normal, what banking should be about.
No, interesting, Kim, and thank you for those insights. And I think maybe we'll wrap it up, but maybe a final question. I guess I have met with quite a few EM, emerging market, portfolio managers and analysts over my time, and I'm always a little bit jealous when I look at the portfolios and I see a Peru stock and a Colombian stock and a Central European and China. So you must travel the world and have seen an amazing number of countries. What is your favourite country or your most interesting country you've visited? And the caveat being that Kim is based in Edinburgh and is, for those that have been there, one of the most beautiful cities in the world.
It is a beautiful city. The problem is the weather, so I like to get away. No, look, we all travel as part of our jobs. For the record, everybody in the office is very jealous that I've come to Australia twice a year for the last few years, because they think that's the best place to be. You're being too kind. No, I'm honest. At least you got decent weather. I mean, everybody's whinging today about the weather to me, but I think this is a great summer's day in Scotland. Anyway, to answer your question directly, I'd say that every country I've gone to has fascinated, excited, and frustrated me at some point, as an investor and as an individual. I have probably, my first boss in the business said to me, never fall in love with a stock, a sector, or a country, because that stops you being objective and, you're just not doing your job, which is fair. But putting that aside, I'd say that without a doubt, the three most fascinating places for me where I think I could probably, one of these kind of fantasies you could have of maybe stopping the clocks, taking time out to go and do something that you don't have time for, and then starting the clock again. I would love to go and spend time traveling more extensively than I have in either Brazil, Russia, or China. I think these countries are all reasonable sized countries, but I think they all have so many layers of history. I'm a great believer, by the way, that if you want to understand why our country is the way it is today, you should start by reading the last 100 years' history. And that's a first really good clue as to why things are the way they are. And I really do think that, everywhere you go, you meet fascinating, intelligent, intellectually curious people who are very happy to talk to foreigners. I mean, very happy to take any dumb question from me, and I think that's the single most enriching part of the job.
No, fascinating. And I must admit, having spent some time in China, I can appreciate your final comment there. Just an amazing country with, so many different races of people.
That's
and
right.
It is so multicultural.
You're right.
When you start to travel around. So, but we'll draw an end to it this morning. So once again, I'd like to thank Kim Catechis, Head of Emerging Markets for Legg, Mason, Martin Curry. I've appreciated your time and your insights there. Thank you very much there, Kim.
Thank you very much. Enjoyed it.
Thanks for listening to this episode of the NetWealth Portfolio Construction podcast series. For more episodes and to subscribe to our series, visit our website www.netwealth.com.au or visit the iTunes Store or Spotify. We hope you can tune into our next episode.